Hey guys, Dane Jansen here from Positive Dynamics. Well, it's been an interesting couple of days in investment markets. It's been a volatile 6 months that we've seen in global markets, but the past couple of days have definitely been very interesting. So the S&P 500, US S&P 500, is now in a technical bear market, which means from peak to trough, a decline of more than 20%. So average time frame of a bear market, very hard to predict how long these sorts of things last for, but on average, the recovery time or the bear market time to get out of that bear market is around about 11.5 months. So realistically, we're about 6.5 months into this one. So it gives me an indication, and this is just one man's opinion, that we're closer to the bottom of this market than we are to the top. So anything that we decide to do now will only benefit us with ability to grow. So when we look at investing more money into a down market, we're potentially at that position where we can start to look at putting new money into this market. Okay, with regards to the reason that we're seeing this market, it's all based around the inflation situation that we're seeing. So inflation obviously is the cost of goods going up. And the higher inflation gets, the more unaffordable things can potentially get. So this is a bad thing for economies, hence the reason that the reserve banks around the world are trying to curb inflation. So they do this by increasing interest rates. And as we've seen, we've had an interest rate hike here in Australia. The US has had a few already this year. And that's going to continue until we do see a stabilization of inflation. All right, the media love to jump on board this bandwagon and tell us that inflation rate in the US is 8.6%, which is high, and it's the highest that they've seen in a very, very long time. They also like to tell us that if the Fed increases interest rates too quickly, it can put us into a recession. And again, that's correct. And a recession is something that we don't really want to see. No one loves a recession. However, from a technical perspective, all a recession is 2 consecutive quarters of negative growth. So the media love to attach fear to these sorts of things because it makes us want to read more news. It's a benefit to media outlets, but realistically, it's not anything to panic about. A recession, as I said, isn't great, but it's not something to lose our heads about. As is the high inflation, that will be controlled with these interest rate rises. Back to recession for a second, we do have some research that has come out, been put out by JP Morgan, who are one of the largest banks in the world, and they don't believe that the US is actually going to see a recession from a technical perspective. So they've obviously come out and said, yes, we've had a negative quarter that we've just recently seen, but they believe that the third quarter of this year is going to be a positive quarter. So they don't actually see that the US is going to go into a recession. With regards to what we can do now, the biggest thing that we can do now is not panic. There's no point panicking and trying to make these significant changes, flight to safety from equities to bonds, for example, due to the fact that we've had this massive sell-off in bonds, which is the biggest sell-off that we've ever seen in our lifetime. Generally, bonds and equities aren't correlated as a rule. However, at this point in time, we're seeing them correlated. We're seeing a negative return in bonds as we are in equities. When you're seeing a 10% pullback in fixed interest and bonds, you know that there's things that aren't quite right. But at this point, there's nothing that we can do as a flight to safety. There's no point trying to drag money from your equities and put them into bonds. It's not going to be an advantage for anybody, and it actually will decrease that longevity that we're looking for in investment portfolios from the perspective of clients that are accumulating wealth for the long term or have accumulated wealth and need to live on that in retirement. It's not a benefit to try and actually make any significant changes at this point in time. The biggest thing that we can do is not panic, and we will see a recovery in the near future. As I said, this is something that the markets have seen many, many times over the years, and it's just another one of these cycles that we're going through. So look, at the end of the day, if you guys have got any concerns or questions, please feel free to reach out to your advisor and have a chat. Until next time, I'll try and keep you guys updated with another video in the near future as we see some changes, as I've got any information or news to pass on. But stay safe and yeah, don't panic.